I think we could get started now. This event will be recorded, so also you will have an access to the event in the after it. So anyway, welcome everybody to the webinar of the Actuary Association of Europe. Today's topic would be on macroprudential issues. We have a title on why actuaries should consider also macroprudential framework. We are quite familiar with the microprudential framework. We have been talking a lot of the Solvency II framework and the aspect of securing policyholders. We are lately we have been talking kind of also shifting more focus to the macroprudential framework, looking things more from systemic and from the society's angle. And this is something, a new topic, which is good to understand. And also, as we know, we have proposals already from European Commission about this one. Also, EIOPA has been doing a lot of good work around it. So anyway, welcome everybody for the AAE webinar today about this topic. We have three speakers, and with that we are trying to kind of cover this quite holistically. We will start with Malcolm Kemp. He's the chairperson of the AAE Risk Management Committee. He will touch upon the issue on the very general level, and setting the scene on what this framework is about, and what are we talking when we are talking about systemic risk. Then we have a pleasure to have Juan Schisse from EIOPA. He's the crisis prevention team leader, and he will go through what EIOPA has been preparing and what their thoughts are around this topic. And as we know, they have done a lot. The last speaker will be Esko Kivisaari. He's the chairperson of the AAE advisory panel. He has been the president of AAE and also very active on the international level. So he will talk about the practical questions around macroprudential framework. We will end the session by Q&A, which hopefully we can have nearly half an hour for that. I would encourage everybody to, when you have questions, please put your question to the chat box. I will collect those questions from there, and then we will deal with those in the Q&A. Hopefully this is fine for everybody, and to deal with the Q&A with this time. We will all the presentations or people presenting will be on the Q&A, so they will have the possibility to answer your questions then. In the end of the session, we will also send an email and ask your feedback. Please do give your feedback. That would be most welcome when we are kind of developing these webinars and coming to future webinars with different ideas. So please do be active on that one. So this would be today's agenda. I certainly welcome everybody, and let's get started. Malcolm, could you share your presentation then, please? Floor is yours.
Thank you very much indeed. I will try to do so. Right, can you see my presentation now?
Yes.
Brilliant. Okay, excellent. Well, as Laurie highlighted, my role here is to kind of set the broader scene. I will touch on how macroprudential thought permeates a lot of regulatory rules and assessments and insights at the present time. But also, and that's across the financial system as a whole, but I'll also look at some of the emerging angles that arise in the insurance space, particularly some of the recent material that's come out of the European Commission. So to kind of set the scene, when people talk about macroprudential regulation, macro-pru stuff, they tend to bunch that together with two other important terms, financial stability and systemic risk. And if you look at most central banks around the world, they typically have a mandate, and not just to control inflation, to provide government with funding, etc., but also to provide financial stability or to assist financial stability. So macroprudential regulation is all about trying to improve the outcome of the financial system as a whole, and to provide some greater stability to how the financial system and economies more generally might develop. So the thinking around macroprudential regulation, probably the term itself became only popularized when in the aftermath of the 2007 to 2009 global financial crisis. But it is worth highlighting that there have been plenty of other previous systemic events, things like hyperinflation, in the 30s and 40s, 1930s and 1940s, savings and loan crisis, the Wall Street crash and the Great Depression, long-term capital management's demise, and a whole host of other events that get bracketed within this concept of financial stability, because at those times, clearly the financial system or systems and economies struggled, became quite unstable. So macroprudential regulation is trying to assist in greater stability and to avoid some of the worst outcomes that might arise if similar events happen in the future. The key insight that drives macroprudential regulation means that we have it as well as microprudential regulation, is that systems, and this is true not just of financial systems or economic systems, have a behavior that is, in a sense, beyond the sum of their parts. So if you have a system where different agents can interact with each other and they're trying to work out what other people are going to do, that creates behaviors that one can't easily tackle just at the individual agent level. Financial stability, because it's linked to this broader concept of societal stability, therefore always is influenced by the current picture, the current economic drivers and issues. And at the present time, COVID-19 is highly relevant to how economies are developing. And so a lot of macroprudential discussion at the present time is driven by thinking about how COVID-19 might impact the financial sector, economies more generally, and what we can do to try and mitigate some of those risks. So it's a very broad topic. If one looks at the way in which instabilities have typically been created in the past, then banking systems tend to be more associated with financial instability. They're often viewed as more prone to systemic risk, and therefore macroprudential regulation has traditionally focused more on the banking sector. But for actuaries, the key message, the key insight here is that finance doesn't work in neatly defined buckets. So the policymakers, when they're thinking about financial stability, are also looking at other parts of the financial system than banks, and considering whether financial instabilities can arise there. Whilst many actuaries would kind of tried to skirt over issues like the bailout of AIG. This is an insurance company, was an insurance company. There are other types of activities that insurers do that are relatively similar to banking. There are plumbing and features like central counterparties that insurers need to rely on because if they're using derivatives. So the financial system is quite interwoven, and therefore one can expect policymakers to want to look at how that interweaving operates, and insurers therefore don't get excluded merely because they're not banks. When policymakers kind of discuss and ponder macroprudential issues, they're obviously going to be influenced by the shape of their financial system. And what I've just highlighted here, it's a few years out of date, but I think the message is still true now, that within the Euro area and within the UK, the banks, when one went into the financial crisis, and indeed still the case now, do look relatively disproportionate in terms of the size relative to the GDP compared to some other jurisdictions like the USA. So in the European region, maybe the focus has been rather more on banks than on some other financial institutions. But as I said, policymakers don't buy into the logic that banks, insurers, asset managers, money market funds, whatever it is, are completely disjoint. Indeed, they're always looking to identify whether there are commonalities and linkages that might create systemic vulnerabilities. Thinking is also influenced by what people perceive to be the potential causes of systemic events. And there are two main kind of theoretical kind of perspectives that one might adopt here, which I've called the domino view and the tsunami view. So the domino view assumes that the failures are to do with one entity running into trouble, that causing a second entity to run into trouble, and a third, and it cascading down. And one can see that in the context of bank runs, if there's a run on a bank, that tends to create pressure on other perceived to be more vulnerable banks, and maybe encourages runs on other banks. So you do get this kind of chain effect. But it is worth highlighting that that isn't the only way that systemic events can occur, even within the banking sector. So the savings and loans crisis in the US, all the entities involved were relatively small in the overall context of banking, but you still had a dramatically bad impact on public finance when enough of them failed or ran into difficulties at roughly the same time. And that would be the case where there's perceived to be some kind of common exposure, common vulnerability that overwhelms the whole sector and causes correlated activity, encourages that, and that also impacts, can be a source of systemic risk. Probably you need a little bit of both of those drivers if you're going to hit a particularly large systemic risk event. But we can talk about that later in the Q&A if you wish to do so. Policymakers are obviously very familiar with the idea of microprudential policy, but because these systemic events can have very sizable impacts, lots of different themes and strands get interwoven into broader perspectives. And I've tried to highlight this with a sort of a little schematic that highlights macroeconomic policy, micro-prudential policy, and micro-prudential policy. And it's at the edges, it's not really practical to differentiate between those three areas. There are going to be the linkage between macroprudential policy and macroeconomic policy. Some of the tools that are now thought of as macroprudential in nature, such as countercyclical capital buffers and other ways in which we encourage banks to continue to lend when the system is in stress, or we discourage them from lending when there seems to be excessive exuberance. Those in previous years might have been thought of as purely macroeconomic in nature. So those types of macroprudential policies, we've kind of co-opted the policy from the macroeconomic sphere into the macroprudential sphere by creating this extra bucket called macroprudential policy. And from the policy perspective, as I said, it's all about big risks to the broader financial system and to economy more generally. So therefore, you can expect policymakers to have in their sights any part of the financial system they think is large enough to, if it blew up, to cause a problem for society and for the economy more generally. And going back to my relative size of financial intermediaries, even in the Euro area and the UK, insurers are still quite substantial, even if they're not as substantial as banks. And therefore, one can expect macroprudential policy makers to have in their sights at least some thought about how insurers might create systemic risk or might be impacted if systemic risks come along. The one tension that will be in the minds of policymakers is how to make sure that you don't kill the kind of the baby with the bathwater, as it were. You need to bear in mind that the financial system is there because it actually helps society operate. So we don't want to stop the financial system from existing, impose so many regulations that we have to abandon finance because that would hinder the broader development of society and the economy more generally. So policymakers will try in their thinking to get ahead of the curve when it comes to behaviors that might be creating vulnerabilities. And I've just highlighted a couple here that might, I think they're lifted from a global financial stability report published by the IMF, which are relevant to actuaries. So over the last decade or so, we've seen a noticeable increase in pension allocations to alternative assets. That's potentially good if that's encouraging the shift to a greener and more sustainable society. They're investing more in those types of assets, but alternative assets may not be as liquid as other assets. So it is creating some kind of vulnerability, and policymakers will be trying to assess whether the vulnerabilities created outweigh the benefits that might or might not arise from that shift in allocation. And I've also listed or shown you a little chart here from the same publication about European insurers' holdings of debt issued by financials, and that seems to be creeping up. That suggests that insurers are becoming more interconnected with other parts of the financial system, and that would be another feature that policymakers often focus on, the extent to which there are interconnections between the different parts of the system that they are endeavoring to protect. Policymakers also try to come up with a sort of slightly more blue sky thinking, which in the risk management world might be called horizon risk scanning, or kind of difficult to quantify types of risks. And we know within the insurance world, in an ORSA, this is something that you are required to do. In a way, you can think of the macroprudential authorities as being a sort of risk managers for the financial system as a whole. So they will want to think about whether the financial system is going to change and what impact that change is going to have on vulnerabilities. I just want to highlight here that firms generally believe that they are going to do well. If you were not optimistic about your own business model, then you're unlikely to persuade other people to be optimistic about it. So there's a natural bias that firms have into believing that they are better than average and have a high probability of surviving over the longer term. Policymakers, so they're kind of akin to being the risk managers for the financial system, need to consider other possibilities. They need to be a little bit more cautious about that type of optimism. And hence, policymakers do think quite a lot about recovery and resolution. What happens if an entity fails? Will its policyholders, customers, etc., get satisfaction? So guarantee schemes are also on the cards. And one might note that because firms do run into financial stress and some fail, they kind of quotes die just like individuals die. And this is, of course, part and parcel of what we in the risk management community, actuarial community, need to think about, because that's where credit risk, it's kind of another name for credit risk. But I do want to highlight that the policymakers won't think of it just from an individual firm basis, but they'll also be interested in it from a broader financial system or financial sector basis. So questions that get posed would be things like whether Europe is overbanked, and there's a sort of strong political emphasis on this capital markets union. If that is as successful as people hope, then the banking sector doesn't need to be as large going forwards as it currently is, because participants will be using other ways of accessing the funds that they need to develop their businesses. So that type of debate would be important in thinking about the robustness of the banking sector as a whole, and therefore individual banks. But within the insurance space, maybe if interest rates stay lower for longer, that is going to cause some insurance business models to struggle. What impact is that going to have on the financial system? A bit more blue sky, and this is something that I'm also looking at myself. It is the potential for disruption to alter the way in which the financial system operates, and therefore how incumbents within the financial system can cope with stresses. And you've got the big tech firms potentially moving into the financial space, or maybe fintech. Some of that disruption might actually come from central authorities. There's quite a lot of discussion at the moment about central bank digital currencies. If they actually were issued, what impact would that have on existing providers of sort of payment services and currency management, i.e. the banks. And broader still, the financial system is going to be impacted by climate change. How is that going to play out? Does that create vulnerabilities? So I hope that gives you a flavor of the different ways in which policymakers will be thinking about the broader macroprudential space and financial stability space. And I just want to mention one or two things about insurance, but I think Juan is going to focus much more on this in his session. So EIOPA is part of that policy discussion, and it's come up with its own proposals in the macroprudential sphere. And these are just a few of the tools that were explored by EIOPA in 2018. Most of them were picked up in the 2020 advice that they provided to the EU Commission with this under the Solvency II review. And the ideas, most of these tools are relatively complementary to corresponding advice from the European Systemic Risk Board. For those of you not familiar with the European Systemic Risk Board, that you have 3 sector-based regulators under the European System of Financial Supervision. You've got EIOPA, you've got the European Banking Authority, and you've got the European Securities and Markets Authority. And then you have another part, which is the ESRB, whose kind of primary remit is macroprudential and kind of thinking about it from the broader sort of space. That body has a variety of committees, one of which I sit on, which is its Advisory Scientific Committee, and it has a lot of input from the different sectoral regulators and individual national regulators. It's worth saying that those of you who are risk managers will appreciate that you're not going to be able to earn rewards without risks. I've highlighted that in a broader context, we do want the financial system to prosper. That appears to be a useful benefit to society as a whole. Because we have financial systems, we have the risk that they will struggle and suffer systemic events. So it's not that we want to get rid of that risk entirely, but we want to maximize the gain that comes from the financial systems rather than the pain. But there are a few particular areas where we might be able to see opportunities from institutions that actuaries typically advise. Things the insurers and pension funds might be sources of quotes patient capital. They might be able to invest more in infrastructure that we might need as societies. Maybe the macroprudential angle can be somehow or other tied in so that we mitigate the worst systemic events, but we still encourage some of these other benefits that might come from these financial institutions. So policymakers are mindful, they do understand these angles, and they're always on the lookout to avoid macroprudential regulation that is kind of not fit for purpose because it discourages these types of opportunities too much. With that in mind, I just want to highlight that the EU Commission in last month issued its Solvency II proposals. There are a variety of objectives that review has, including, for example, better addressing potential buildup of systemic risk in the insurance sector. And given that backdrop, it's natural that some of those proposals are specifically macroprudential or tagged as macroprudential in nature. It's worth saying that a lot of the other proposals could be viewed or can be argued to be macroprudential to some extent. Big regulation, it's going to impact the financial stability, and sound, transparent regulation should help with financial stability more generally. So a lot of the aims and goals of the Solvency II directive are trying to address financial stability. So I just want to highlight only those that have got a specific macroprudential tag, as it were. And this page here just highlights a few of them that the European Commission are going to propose to include within the Solvency II directive. Greater focus on liquidity management, on what's covered in the own risk. Maybe insurers won't be very happy are given to regulators to do with ability to suspend dividend and distributions and similar capital returns to investors. But the experience of the COVID crisis, the EIOPA, ESRB, and others were keen to introduce such restrictions and discovered that they didn't really have the power to do that. So that's trying to close a stable door that was seen to be weak. And then the other sort of proposals that are specifically badged as macroprudential involve the introduction of a recovery and resolution directive. I've heard people ask, well, why do we need an IRD if we already have Solvency II? But we have an insurance distribution directive. We have other directives that influence insurers. And given the size of the IRD that's proposed by the European Commission, it's hard to see how you could weave that into the Solvency II directive. We're talking here practicalities when it comes to drafting legal texts. But the sorts of things that are included in this insurance recovery and resolution directive would be authorities who would actually look after resolution if an insurer failed, more harmonization of the tools that can be used, and a variety of safeguards and procedures to ensure that if things do go bad, that the processes involved are not going to unfairly impact different parties involved in the failed institution. And then there's also a requirement to think about how you might avoid this issue in the first place, preemptive recovery planning. So more work for firms, therefore presumably for actuaries, which may not be welcomed by those firms, but the logic behind them does follow from the if you believe that the particular sector that you're focusing on does have systemic vulnerabilities, then some means of handling those systemic vulnerabilities and the pain that arises if systemic events do actually arise does seem, at least to me, relatively sensible. So just to kind of summarize, you've got these three concepts: financial stability, systemic risk, and macroprudential regulation. That they're kind of three different terms that are largely the same in terms of what people are focusing on in their thought processes. all share the insight that the behavior of the entire system isn't necessarily well predicted from the behavior of each individual component because of the way in which interconnections operate. Those interconnections don't actually need to be direct, they can just be behavioral, and you can see impacts. If the situation is sufficiently challenging, then those behavioral aspects can be very important indeed. Looking at it from the perspective of firms, firms would typically like to believe that everything is rosy. Policymakers tend to be more expansive, less willing to buy into that logic, and more skeptical about how firms might operate, but they will still try and limit their proposals.
Please do mute your microphone, please.
Okay.
Okay, sorry.
Yeah, no problem. So just to finish off, so policymakers tend to adopt a more expansive and more skeptical view as to how things might develop. But policymakers are mindful that the purpose of finance in a broader context is to support the economy and society, and they don't want to throw that out in the process of introducing macroprudential policy. The point here is that policymakers will probably draw the balance more intrusively than firms might like. And policymakers have in their scope anything that's sufficiently large, and from our perspective in this webinar, insurers get included in that space. So thank you very much. That's all I wanted to cover in these opening comments.
Thank you, Malcolm. Really, really helpful, and you certainly gave a good kind of a overall picture of this topic and lots of examples, and also touched upon the EIOPA work, which is something that we will hear now from Juan. Just to say, everybody, please do use the chat box if you have questions. You can send your questions straightly to me or to everybody. Anyway, I will collect all the questions and then come back with those in the Q&A session. But now let's turn to EIOPA's work around this. Juan, please, floor is yours.
Hello, can you hear me well? I hope so.
I do, and I see your presentation.
Excellent. So now the first thing is, of course, thanking the organizers for inviting me to this nice workshop. My name is Juan Sanchez. I joined the EIOPA in 2012, and since then I've been working on crisis prevention and management related topics. This includes, among others, recovery and resolution. I was very happy to see that Malcolm also mentioned the Insurance Recovery and Resolution Directive, to which we also contributed. It also involves insurance guarantee schemes. Here I'm, of course, less happy to see that it didn't proceed. And the third leg is also the macroprudential policies, which is the topic that we will discuss today. Now, this is an overview of what I will discuss today. I will start briefly by referring to why I think that macroprudential policies are important in general, and then focus a bit more on the approach that we have developed in EIOPA, which is basically about the three items that you see on the screens next, which is systemic risk in insurance, Solvency II tools, and then also possible new tools. Then I will finalize with some additional slides on why and let me stress from the beginning, as a non-actuary, why I believe is that macroprudential policies are important for insurance. And this is a bit what I have in mind for today. Let me just go to the first line. I will go briefly here, because I think Malcolm did an excellent job in terms of explaining a bit what is micro, what is macro, and what the differences are. But I always like to start these kind of presentations with this nice table that clearly shows what the main differences are, right? So the micro-prudential approach, which is the more traditional supervisory one, focuses on risks and vulnerabilities at the level of individual institutions. That's important. And the main objective here is to protect policyholders. Now, what we want to now discuss today is a macro-prudential approach, which in turn is focusing more on the buildup of risks that may compromise the stability of the system as a whole, as Malcolm was explaining. So we're not necessarily talking here about individual institutions, but we are discussing about the system as a whole, and we are considering things like correlations, common exposures, or even common behaviors. So this is a bit what macro-prudential is about. Now, it is also something that Malcolm clearly explained. I think it's both approaches are actually supplementary. I think, furthermore, the border between one and the other is not always clear. And for example, a specific tool or a specific measure or decision may have also macro impact, even if it's done at the level of individual undertakings. The second question I wanted to address is, why do we think that this is important? And I think there are two main reasons for that. The first is that what the recent financial crisis has shown to us, and is the fact that the stability of individual companies is not necessarily enough to guarantee the stability of the system as a whole. And I think that's important, because this leads to the conclusion that then also the tools that you need to guarantee the stability of the system as a whole should be specific, should be developed. Malcolm also mentioned that it was obvious for the banking sector. We always have the banking sector running ahead, but I think with the appropriate safeguards, it's also valid for the insurance sector. Precisely because of the lessons that we learned from the financial crisis, several international bodies and standard setters started developing different proposals in the field of crisis prevention and management. I'm sure most of you have heard about the FSP.
Yeah, Juan, we have it doesn't, could you maybe turn your video off for a moment, I think, and we don't see, yeah, sorry.
Is it better now?
Yeah, it's a bit better now. Could you just share your presentation once again, so.
Is it not being shared? Okay, let me see.
Yeah,
Let
sorry about that. Now I see your presentation. Yes.
Okay. Can you see it now?
Yes. Thank you.
Was it lost then?
I think it was it disappeared, but anyway, now it's there. Thanks.
Okay. Sorry about this. Sorry about this.
No problem.
So what I was just basically saying that a lot of standard setters and international bodies started developing proposals. And of course, these proposals have to be included, has to be implemented in the EU. And what we want to make sure is that this is done in an homogeneous way. This is done without creating additional fragmentation. Now, let me see if I can. Yeah. So this next slide basically is what we are trying to do here is to express a bit how our approach looks like, because although the discussion started indeed in the banking sector, we started seeing that they were spreading over to the insurance sector. And of course, we as an European institution wanted to be prepared. We wanted to have our own views, we wanted to develop our stance. And what is more importantly is we wanted to really contribute to the discussions with a clear insurance mind, in order to avoid what we have seen in other instances, like the kind of copy-paste approach from the banking sector. So this is something that we wanted to avoid. So we basically started working on macro-prudential policies in 2017, and we followed a sequential approach. And the sequential approach is exactly what you see on the slides. So we tried to answer three main questions in a sequential way. The first thing is, does insurance create or amplify systemic risks? If yes, what tools do we already have in place at that time, of course? And do we need additional tools? Should the available tools not be enough? Now, each of these questions substantiated in a paper that we publish in our website, and you can see I added a slide with some reference at the end of my presentation. But let me briefly touch upon all these three questions. The first question is about systemic risk in macroprudential policy in insurance. So can the insurance sector create or amplify systemic risks? We think that from a theoretical point of view, it can indeed happen, and it can happen by means of three different perspectives. An entity-based perspective, so basically like a large insurers failing, or also collective failures of not so large insurance, but collective failures that, because of common exposures, they fail, and then this create an issue for the system as a whole. We also consider an activity-based perspective, so basically insurers getting into what was formerly known as non-traditional, non-insurance activities. And these activities, we know that they are more likely to create systemic risks. And thirdly, also what we call a behavioral-based perspective. So basically insurers behaving in a certain way, such as a search for yield, leading, for instance, to procyclical behaviors, etc. This is something that, as Malcolm was saying, is something that worries the policymakers. Now, let me stress also that this approach, which we developed, is largely in line with the approach of the ESRB that Malcolm mentioned, and the IIAS. Of course, we were also part of all these discussions, so I think there is a quite high degree of convergence between all these institutions. What is basically the bottom line here is that we think that insurance can create systemic risk. Okay, we think that it is clearly less prone, that insurance is less prone to systemic risk than the banking sector. But because it can still happen, you actually need to be prepared. So this brings me to the second question, because if we accept that the insurance sector can indeed create or amplify systemic risk, then of course the next logical step is to think about what tools are available, or what tools were available at the time in Solvency II. And we think that that Solvency II, although it's clearly a micro-prudential framework designed to ensure the solvency of institutions, it has also macroprudential impact, and it has macroprudential impact, we think, in three ways. Basically, the first, the design of the framework itself. Obviously, it's a prudential framework, and the main objective is to ensure sufficient loss absorbency capacity in reserving, and this is one of the key macroprudential objectives. So from that perspective, it's clear that the design of the framework contributes to from a macroprudential point of view. Second, the elements whose impact is indirect. So we have some elements in Solvency II, like for instance the capital own, the ORSA, the prudent person principle, etc. We know that they are micro in nature, but we also know that they might have also an impact from a macroprudential point of view. And third, and most probably the most important part, is the elements that have direct macroprudential impact. And this, if you allow me, we'll touch upon briefly in the next slide. So we basically identified 5 tools, including Solvency II, which in our view do have an impact also on from a financial stability point of view. But essentially they are designed to limit procyclicality, and these are the ones we're including in Omnibus 2. So we have the symmetric adjustment to the equity risk charges that contribute to reducing the effects of extreme volatility in the markets. We also have the volatility adjustment that aims at mitigating the effects of short-term volatility of bond spreads on the solvency position of insurers. The matching adjustment, which incentivizes insurers to hold certain long-term assets with cash flows that match the liabilities. And we know that this is particularly important in the current low interest rate environment. And we also have the extension of the recovery period, which we know it's a powerful tool that relaxes a bit the requirements on companies to avoid that, it may end up being procyclical. And then, of course, we also have the transitional measures that seek to minimize the impact of regulatory changes. So I think altogether, these tools that we identified do have macroprudential impact. We think that they have been working quite well. Of course, all the debates better than me that have taken place in the context of our opinion in 2020. But in essence, I think they are powerful tools. However, we identified in the previous slide the source of systemic risks, and we see that most of the tools, or all the tools that we identified in Solvency II, they do essentially contribute to one of the main objectives of macroprudential policy, which is limiting procyclicality. We believe that there is still room to basically think about possible new tools, and this is exactly what we have done in the Solvency II opinion that we published last year. Let me briefly touch upon our proposal. Malcolm already explained a bit what this was about, but let me just try to explain you a bit more what we think of how we see macroprudential policy. What you see in this current slide is a summary of the three things that we are proposing. So basically, we propose that there is a need to incorporate the macroprudential perspective in Solvency II. We believe that Solvency II was in general lacking this perspective, and I think it's worth adding this perspective because of the reason that we have already mentioned. The directive, the Solvency II directive, should, in our view, not only have the protection of policyholders as an overarching goal, but also consider financial stability as an important objective. And last but definitely not least, we think that if we accept that there is some kind of risks there that are not properly addressed, then we need to also broaden the toolkit of authorities to basically cope with all sources of systemic risk. Let me stress that the discussions took place in parallel to the discussions on other features of Solvency II that also have macroprudential impact. We discussed all the VA, the MA. We discussed also the last liquid point. All these things have also been part of the discussions in Solvency II. I will not enter into those. I will focus basically on these new tools that that we will just see. But I know that the association has been extremely active on contributing with technical input to all this process. Now, we were of course very positively surprised when we saw that on the 22nd of September that the European Commission had taken most of our advice into consideration. So this was, of course, good to see from our side. We started in a situation where there were some doubts about should macroprudential policies be part of Solvency II or not. I think in the end the proposal includes an important part of our advice, and we think that's definitely something very positive. Now, let me just before I start to briefly touch upon the tools that we are proposing, let me just focus on the principles that we think are important. The first principle that has guided us in our proposal is that as we mentioned, we really wanted to focus on the insurance sector. This means that we wanted to really take into account the insurance specific features. We know that because of the less likelihood of systemic risk to happen and the business model of insurance, it is clear that we need other type of tools, probably less intrusive than in the banking sector. This is why our proposal, if you think about it, it's going to be less intrusive. It's going to be more focused on planning, preemptive, than it is in the banking sector. Second, our idea was, of course, making sure that we have enough tools in place to address all the sources of systemic risk that we identified. And of course, to the extent possible, we also wanted to, limit the number of new tools. We wanted to make use of the existing tools, which we think that, have worked quite well, and maybe broaden them. An example of it is the ORSA, or the prudential principle, as I will explain in the next slides. We also decided that the tools should be exercised on a discretionary basis. So, we don't believe in hard triggers. We don't believe in automatism. We do believe, that there needs to be enough room for expert judgment in the policies. Of course, it is clear that the more you depart from rules, and the more you move toward discretion, it's clear that this leaves more room for interpretation. But we do think that this is more in line with the kind of risk that the insurance sector may have, and also the way insurance works. So this is something we wanted to make sure. And then also an important one, which is proportionality. This is a guiding principle throughout the whole EIOPA proposal. And of course, it's also a principle that we have tried to follow in our advice, particularly when it comes to the use of the tools. We always included ideas on how to apply the framework, the tools in a proportionate way. As mentioned, because we started all this work from scratch, because most of the literature, most of the work had focused on the banking sector. And when we started, there was not so much on insurance. We acknowledged these limitations, and we thought that we need to first try to come up in an early stage, try to come up with the principles and focus on the principles. But of course, this means that there are several important operational details missing, or several areas for further work, which we did identify in our opinion. If you read the opinion, you will see them. They're highlighted. We wanted to be transparent. But we did not fully address them. We think that this can be done at a later stage by means of developing the necessary technical material that we'll have to develop. Entering now into the specific tools. What you will see on the next two slides. A green tick if EIOPA's proposal was taken on board, and a red cross if it wasn't, if the proposed tool was not included. In our proposal, we wanted to cover the whole possible spectrum of tools, and we included tools touching about capital. We touched upon exposure-based tools, preemptive planning, and liquidity-based tools. I will briefly go through the main ones. So on the capital-based tool, we propose the inclusion of two tools. We propose that NSAs should have the discretion to make use of a capital surcharge for systemic risk whenever they deem it necessary to mitigate unidentified risks. Let me state that we acknowledge that capital should not be the by default answer. So capital does not solve everything. We know that, but we say that there might be some instances where a certain capital surcharge as a preventive measure, trying to prevent the buildup of risk, may indeed have a rationale. Of course, if this tool had been included, it should be used under clear explanation of why the tool is used, how to ensure proportionality. But in the end, the tool did not survive the Commission's cut, so it is not part of the Commission's proposal. The second tool we propose is that supervisors should have the possibility of restricting or suspending dividends or other payments. However, we know that this is a tool that should only be applied in exceptional circumstances, and of course, as long as the underlying reasons persist. We also propose a couple of what we call exposure-based tools. The first is a soft concentration thresholds, which did not proceed, so the Commission will not include it. We know that Solvency II is a principle-based framework, and we believe that this should not change, of course. And this is why we refer to soft thresholds against or contrary to hard thresholds. If a threshold is hard, this means that essentially you cannot breach the threshold. So if the threshold says that you cannot have more than 60% of government bonds in your portfolio, you simply cannot go beyond that. But what we were proposing is actually that NSAs define soft threshold that could indeed be breached. But if this is the case, then of course this would raise the attention of the supervisor, and they will want to see what is the rationale behind it and act if there is a need to do so. As I said, this will not be included in Solvency II. But what will be included is something that we think is very important, is the expansion of the ORSA and the prudent person principle to include macroprudential perspective. So here we are talking about broadening, not changing the approach of these two already existing tools. We know that they are in essence individual entity-based tools, but what we were thinking is that perhaps there is a way to also consider macroprudential concerns as well. First, by authorities, not only by companies, but first by authorities who should provide relevant macroprudential information to undertakings, maybe as part of the supervisory dialogue with them, but also by undertakings who we believe should take this information into account in their ORSA reports, but also in their investment policy. This would create like a kind of information feedback process between authorities and the entities for the benefit of the system. This was a bit our approach. Moving on to the preventive planning. EIOPA proposed to enhance the preventive sphere quite significantly. As I said at the beginning of my presentation, we think that prevention in the case of insurance makes more sense than just intrusive tools. Although it may look like too many plans, the reality is that undertakings, and NSAs also in the case of resolution plans, they are already thinking about all these issues. So we are not including anything absolutely new. We think that this is actually good risk management practice to think about liquidity, to think about what kind of planning scenarios could bring the company down. And what we are only proposing is to formalize it a bit further. Let me just give you some basic ideas on the different plans. As part of the Insurance Recommendation Directive that Malcolm was referring to, we propose that recovery plans should be requested to undertakings covering a very significant share of the market, and this should be done in a proportionate way. Why? Because we truly believe that these plans had to reduce the likelihood of an insurance failure. The idea is again to enhance preparedness for adverse situation, allowing them to basically take informed and timely remedial actions when needed. So we think these plans, we do have recovery plans in Solvency II, but they were plans only in case of a breach of the SCR. And here we're talking about preemptive recovery plans, which means the company thinks preemptively about scenarios that could bring the company down, measures, etc. So this we think is a good risk management practice. In the same vein, also we ask authorities to draft resolution plans, and they should cover a significant share of the market. Here, the objective is a bit different, because if recovery plans seek to reduce the likelihood of a crisis, resolution plans seek to minimize the impact of the crisis. So basically, how can we resolve a company without severe systemic disruptions, and of course, without exposing taxpayers to loss? This is a bit the idea of resolution plans. As I said, this is part of the new Insurance Recovery Resolution Directive, to which we also have contributed with technical advice. The third plan we were considering is the systemic risk management plan. Of course, here the scope of undertakings that we proposed was less than the ones for preemptive recovery resolution plans. We think that it should focus basically on those undertakings that may create or amplify systemic risk based on the judgment of the supervisors. And basically, these plans should reflect these activities and how to manage these activities in a way that do not create systemic risk. But as I said, these plans have not been proposed in the Commission, have not been included in the Commission proposal. But what has been included is the liquidity risk management plans. We think that these are very important plans. As I said, I'm sure that all companies are thinking about potential liquidity stresses, potential liquidity scenarios that may pose the company into stress. How do we address those situations? What tools do we have in place? What's the timeline? All these things, we are sure that it's part of the discussions that companies have as part of the risk management framework. And what we are only doing is just trying to formalize this in the Solvency II review. Just focusing on the last set of tools, I will stay now also on the liquidity side. We also proposed a liquidity risk monitoring framework. So, what we wanted as EIOPA is to have a more structured approach to liquidity risk within Solvency II. And this implies, for instance, making the NSAs able to obtain from undertakings the information that they deem necessary for the purpose of, monitoring, supervising liquidity risks. But also, if liquidity risk monitoring and stress testing allows or identifies vulnerabilities at the level of undertakings, then we believe that supervisory authorities should be granted with specific powers or for additional mitigation measures to address those situations. This liquidity risk monitoring framework was included. This tool, as I was mentioning, this framework seeks to prevent liquidity risks. But the question is, okay, if there is a liquidity crisis already, how do we deal with it? And this is what explains the inclusion of the last tool that is in the slide, which is the temporary freeze and redemption right. Because contrary to the previous one, this is a crisis management tool, a genuine crisis management tool. The proposal is to grant supervisors, national supervisory authorities, with the power to impose a temporary freeze and redemption rights. And here it's very important, in exceptional circumstances and as a last resort. So we are not talking about something that is supposed to stay be in place for a long time. We are talking about very temporary measures that would allow undertakings to gain some time to take additional measures and avoid that in the end, a liquidity crisis turns into a solvency crisis. So this is a bit the idea of this of this tool. As you can see, the European Commission has included most of our tools, and of course we are very happy about it. Also because we think that the menu of options that have been included within this toolkit, there is at least one capital, one exposure, one liquidity, and several planning tools, which is very good. And we also have both crisis prevention tools, but we also have two powerful crisis management tools, which makes the proposal, in our view, quite complete. So sorry, and I'm now moving to the last part of my presentation. This is a bit more the part where I try to really answer or provide some thoughts about why I believe that actuaries, again as a non-actuary, why do I think that actuaries should care about macroprudential, which is the main topic of the day. Let me just make some initial considerations here. I think we would all agree that macroprudential perspective is in essence out of the scope of actuaries. At the same time, however, actuaries are part of and can influence on the macroprudential environment. And indeed, as mentioned before, the border between the micro and the macro is not so crystal clear, and there are strong interrelations between both spheres. This is what I try to reflect in this illustration. So, for instance, things like micro actions or micro decisions may have macro impact. So not only because a large company can affect the system as a whole, or because small companies acting together could also affect the stability of the system. But it's also that measures adopted by macroprudential authorities need to be ultimately implemented at the level of individual institutions. So even if there are macro measures, in the end, it all goes down to the level of individual institution. And also here, you can just choose any of the measures that we have been discussing in the two previous slides, and you will see that in the end, the implementation is done at the level of individual undertaking. So this again a clear relation between micro and macro. And finally, but yet importantly, there is, or at least there should be, a kind of feedback loop between the information produced by actuaries and companies that can help macroprudential authorities and the one produced by authorities that could help also the actuaries, or could also help the companies. And this, I mentioned the case of ORSA, this feedback loop that I was trying to describe. All in all, we think that actuaries can assess the design of macroprudential policies, and they can support in the implementation, which is key from my point of view. So let me just go quickly in the next slide, where I will try to follow the structure that I've been following and trying to see to what extent, to the different questions, actuaries could actually contribute to the macroprudential policies. If you think about the first question or the first topic, which was about systemic risk and macroprudential policies, I do believe that the role of actuaries in this context could be the following, is the following. So first, actuaries are well placed to basically identify, assess, and monitor market trends, products, designs, and also what is something very important, policyholder behaviors. And this may eventually signal future systemic risk events. So this monitoring part of actuaries is really, really important also from a macroprudential point of view. But we also think that actuaries can contribute to mitigate systemic risk. For example, ensuring financial soundness of insurance, which is at the core of the actuary's role. If actuaries or if the companies are well capitalized, if there is sufficient loss absorption capacity and reserving, which is one of the key macroprudential objectives, then this means that the sector overall as a whole will also be solid, will also be well capitalized. And this is clearly something that is within the scope of macroprudential policies. Second, we see day to day that new products are being launched, new features of old products are being considered, and I think it's very important. I think actuaries are in a very good place to identify innovation, but also what is more important, to identify risks associated with these innovations and how this risk may spill over to the rest of the system. So this is something that is very important. For example, what new risk entail this or that product? Do the correlations with other products and sectors increase? If yes, what's the impact? All these are questions that actually could think about and could also try to mitigate the possible risks there. Also very important, actuaries can design can contribute to the design of sound models, or put it differently, actuaries can contribute to minimizing model risks. We know insurance companies have increasingly been using sophisticated models. We do think that this has clear benefits, but at the same time, it may also become a source of systemic risks. So, and this is something that falls within the area of responsibilities of actuaries. In the same vein, actuaries could consider investment risk also within the macroprudential context, and we explain, or I briefly touch upon it when I address the expansion of the prudent person principle. I think issues of type of assets, concentrations, all these things, all these considerations should also be part of the investment policy of undertakings, and I'm sure it is already part of it. So probably no news there. Also, very importantly, is that reinsurance. I think actuaries should consider what reinsurance are we working on with. What's the concentration? Is this a risk? Is this a risk for us? Is this a risk for the system? All these things is something that actuaries should think about. So as a result, I do believe that the actuary contributes decisively to the public trust in the sector. And this, of course, supports this saving mobilizer role that is usually explained with regard to the insurance sector. And it also mitigates the insurance runs, which is something that we are more rare in insurance and in banking, but it is still possible. Second question. Now we have seen that we addressed the contribution of actuaries to systemic risk, but now let's think a bit broader also in terms of how actuaries contribute to the actual implementations of the tools in Solvency II implemented in a solid way, which of course also contributes to the stability of the system. These are just examples. For example, they actually could support the correct use of certain tools. For instance, actuaries provide scenarios, they models, cash flow projections for stress testing, which are key tools for institutions, but also for the system as a whole. With regard to ORSA, actuaries should be able to identify emerging risks, not only the risks that we know, but also emerging risks that may affect the company. And if this is done properly, of course, this provides a decisive contribution to the stability of the system if all the companies do the same. Also on the implementation of the prudent person principle that I was mentioning before, how do macroprudential risks affect or impact our investment decisions? This is something that goes beyond the individual exposure and risks. In case of a breach of SCR, we know that Solvency II requires a recovery plan. I'm sure that actuaries can help in drafting, in designing the plan in a way, that the company can recover from the stress. So these are all very important functions or contributions of actuaries. Of course, actuaries can also contribute in highlighting potential shortcomings of the tools, and we know, we've seen this in the course of the EIOPA Solvency II opinion. All this, in our view, provides a decisive contribution also from a macroprudential point of view. And maybe the next topic, which is, okay, what can actuaries do with regards to new tools that are being proposed, that are being implemented, the new macroprudential tools? Well, I think actuaries are the ones who are closer to the ground. So they are really the ones who know the company. They are really the ones who can really support the work of macroprudential authorities by sharing experience, by assisting in the technical work, in the technical discussions of what tools could be implemented. And again, here I think the Solvency II opinion has been a good example where we have seen that actuaries and also the association has been very active contributing to the discussion. And of course, they can not only highlight potential shortcomings of the proposed tools, but they could also help, in shaping them. They could help in implementing them. For instance, these are just two examples. On liquidity risk management plan, actuaries can identify the source of liquidity risk, the mitigating measures, or in the case of preventive recovery plans, they can identify risk areas, scenarios, measures, impact. All these things are absolutely fundamental from our perspective. Now, I'm reaching the end of my presentation, and I would like to conclude, by using a Spanish saying that says that let us not miss the forest for the trees, which means that we should focus not only on what is immediately in front of us, but also on what is beyond. We need to look a bit beyond what is just in front of our eyes. I think personally that the actuarial function is too valuable and to focus exclusively on the stability of individual institution. It also needs to consider that the system as a whole, as we have been saying several times during the presentation. Furthermore, there are actions and decisions that they do not stay at the level of undertakings. They go beyond, and this is so important. So the question is, so if actuaries are part of this ecosystem and they have a stake on it, should really they not care about macroprudential policies? I think that the answer is obvious. Thank you very much.
Thank you, Juan. Thank you really much. I think you did cover well kind of the wide range of the tools and the thinking that you have been doing in EIOPA, and I think we really got a good flavor of all what you have on the table. Thank you also for covering the topics from the actuarial angle, I think, which is certainly an interesting point for the members. But anyway, let's go forward now. Everybody, just please send your questions via chat to me or to everybody. Let's cover some. Now we will next have Esko. Esko, we have a bit kind of but we have a kind of a bit timing issue, but please don't make it shorter. We can certainly squeeze the Q&A a little bit. But Esko, now the floor is yours, please.
Thank you, Lauri, and of course the timing issue is your problem, not my problem. But anyway, I hope you see my first slide already. Yes, you see. So happy to continue after Juan from the country with lots of forests. So maybe this is a continuation to that. I would congratulate first and thank the AAE for having this topic on the agenda and for the webinar. Because to me, I have had the feeling that actuaries are next to illiterate when it comes to macroprudential issues. Actuaries have their comfort zone in microprudential and Solvency II, but you need to be active also and literate also in the macroprudential area. I was a little shocked first with Juan saying that in essence actuaries shouldn't consider macroprudential, but Juan had very good reasons why we should be there. When looking at this topic, this issue, firstly, when I had the presentations of the slides of Malcolm and Juan, I had the feeling that the first speaker will tell all about all that I was about to tell, and then the second speaker will comment on it. So there is not much left. But then I decided to concentrate on the resolution issue and go to like have this narrow case of what resolution means, what it tries to answer. However, before going to resolution, I would like to stress one thing that I thought was a little missing in the former presentations, and it is the fact that when we talk of macroprudential issues, macroprudential regulation, we actually, when it comes to banking, we have two kinds of macroprudential issues. We have the so-called structural issues, and then we have the counter-cyclical macroprudential measures. The discussion and the presentations, I would say, were much more or nearly totally in the area of these structural issues, where you try to avoid the sector causing harm to outsiders or causing harm to taxpayers in the form of bailouts. Then the counter-cyclical macroprudential measures are such where the sector can help the societies in getting along. And during these COVID-19 times, I think there's been quite successful use of counter-cyclical macroprudential tools within the banking sector. I mean, one part of banking macroprudence is to require higher capital requirements, higher capital levels during better times, and then release or lower the requirements in downturns. In the banking sector, such tools work very well because banks, so to say, create money, and if capital requirements are lowered, then banks can really extend loans to the society, to the businesses, and help the society go through a downturn. I haven't seen good examples of counter-cyclical macroprudential tools in insurance because the business logic is so different. But I thought it's essential to mention that we have these two areas in macroprudential regulation. But what I was about to tell you, it was like where the ideas of resolution come from, how they come to the insurance sector, and how they then emerge in European regulation. Okay, and I think my slides are even moving forward. The idea of resolution was more or less born during the previous financial crisis. The Financial Stability Board, firstly, it looked at banking and other services, and then it also touched insurance a bit later. The Financial Stability Board has its key attributes of 2014 for the assessment methodology for the insurance sector. Firstly, it has some prerequisites, and then it has the key attributes. It says that on the basis of anything, there needs to be a well-established framework for financial stability, surveillance, and policy formulation. So, and also an effective system of supervision, regulation, and oversight. So the cornerstone of everything is to have a good legal basis. Then the second area is to have a good mechanism for the protection of policyholders, a good accounting, and otherwise a well-developed legal framework and judicial system. The key attributes, firstly, when we look at the Financial Stability Board, it basically looked at systemically significant players. So it says that any financial institution that could be systemically significant should be subject to a resolution regime. And there should be an authority, there should be good powers for the authorities. There should be a mechanism of setting of the rights and contracts so that resolution is possible. And then there should be a hierarchy how claims to the institution are handled so that those with higher priority will get their money back sooner than those lower in the hierarchy. Then an important idea here mentioned with previous speakers is that the idea of resolution should be to avoid bailouts. That is to avoid taxpayers having to take care of the resolution and with taxpayers carrying the cost of anything done. Especially when it comes to Financial Stability Board, a big problem is that many and even most of the systemically important institutions are cross-border institutions, which means that there needs to be strong cross-border cooperation and crisis management groups. Then there are, like I would say, smaller topics at the bottom of the list, especially having ideas that resolutions should be, the states should be able to put resolution practices also to make them come true and not just on paper. In insurance, Financial Stability Board is the general body looking at all financial markets together with the GX structures. Along that, we have the IAIS, the International Association of Insurance Supervisors, which is updating or keeping up to date its so-called core principles. Basically, again, the IAIS is not looking at every institution, but concentrating on those systemically important ones. It has the term internationally active insurance group that is in its main focus, and the core principles really deal with those institutions. The IAIS has also identified global systemically important insurers. These core principles that you can find in total in IAS pages, it has ICP 12, which is about exit from the market and resolution, talking of voluntary exit, where undertaking decides for its own reasons to withdraw from a market and what happens then, but it's also has the ideas on the resolution of insurance, that insurers that are no longer viable are or are likely to be no longer viable and have no reasonable prospect of returning to viability. IAA starts from the idea that policyholders should be protected and the losses should be absorbed in a manner that respects the liquidation claims hierarchy mentioned already in the FSP key attributes. One can already maybe here say that these two bullet points are a bit problematic. These are easy to implement in banking, where the balance sheets have lots of elements, lots of instruments that can be built in, so to say, to make investors pay for the resolution. Mostly in insurers, there is not so much other things in the balance sheets than those that are really connected to insurance, connected to clients, which means that it is hard both to protect policyholders and absorb losses, because absorbing losses quite soon means cutting the benefits of the policyholders. IAIS starts from the idea that it looks at the balance sheet of the insurer, which is either solvent or it is already insolvent, but there is the gray area between nicely solvent insurer and insolvent insurer. Before an insurer is outright insolvent, it can be in a situation where the insurer is no longer viable or likely to be no longer viable. And when we talk about different actions in different stages, then certainly when the insurer is well solvent, it needs to take preventive measures. It needs to look at different scenarios to make certain it will remain well solvent. When it is getting closer to insolvency, getting to the area of non-viability, getting closer to the area of non-viability, there is the need to have recovery plans in place. But then there might be trigger point which is so to say a point of no return, and there we enter the resolution phase. Of course, one of the really difficult big questions is that how to set the trigger point if it is in the area where the company is still solvent, but then on the other hand, beyond this trigger point, there could be incentives for the company to take more risk, to try to do something miraculous to return back to being well solvent, and therefore it is understandable that there are thoughts of making an intervention already before that with the resolution with resolution measures and the resolution authority. When looking at the criteria, then again it is the idea of protecting policyholders, saying that that policyholders will not be fully protected under all circumstances, and some losses can be absorbed by policyholders. But then again, the legislation should have a scheme that prioritizes the payments of claims, and first it tries to take everything, like write down the equity and write down or bail in certain instruments of the liabilities of a company. But absolutely what is tried here is that the resolution should seek to minimize any reliance on public funding. That is, taxpayers should not be liable of paying anything to what happens. Then when we look at the Commission proposal this September, it is really about introducing resolution measures to the regulation. It proposes setting up or proposes requiring member states to set up resolution authorities for insurance with minimum harmonized powers. It aims at having 70% of undertakings in any member state to be subject to resolution planning. So this extends when FSB and IAIS look at more or less like this systemically important once the EC proposal goes further in requiring, say, 70% of undertakings to be under resolution planning. Then what the Commission wants is that resolution plans should not rely on public assistance from taxpayers, and there should also be a common parameter for triggering the application of resolution tools. The idea, again, as I said, is the write-down or conversion of capital instruments and other instruments that should make it possible to respect policyholder rights, to have policyholder protection in place. There are possibilities in this area, like having a run-off, how to run off a business by making it by prohibiting the conclusion of new insurance or reinsurance contracts. There might be the possibility of selling all or part of the business on commercial terms. Some parts of the business can be transferred to a publicly controlled entity, and there might be the problem of might be the arrangement where assets and liabilities are separated and transferred to another vehicle to manage the rundown over time. One of the issues there is the relationship between resolution and possible guarantee schemes. We have insurance guarantee schemes in many EU countries, but they are not really harmonized and they differ from country to country. The Commission proposal says that insurance guarantee schemes could contribute to the funding, but on the other hand, insurance guarantee schemes should not be worse off than in a case of full bankruptcy. To do some summary on what is happening on resolution in Europe, our proposal, or the EC proposal, to a large extent fulfills the guidelines of the Financial Stability Board and the International Association of Insurance Supervisors. There is the aim to have policyholder protection and avoiding the need to use public money. There is somewhat lower emphasis on financial stability when we look at the Commission proposal. The two areas at least that I think are quite important, and both of them I think take the issue closer to actuaries. Firstly, as I already mentioned, there's difference between resolution in insurance and banking, and to my understanding, the main maybe philosophical difference is the business model. Banks, especially larger ones, have quite a lot of stuff in their balance sheets that is not about deposits or loans, but it is money market money, or basically investor money, not only equity, but also different bonds. And the idea in the banking area in resolution is to bail in investor money so that the so to say core business of collecting deposits and extending loans can be somehow managed and even written down. The difference between banking and insurance is that most of the money in an insurance company is really policyholder money. And the problem there with resolution is to how to write down anything without really hurting the policyholders. So in a sense, one can say that the line between a normal bankruptcy and a resolution is fairly thin, and it needs to be clarified what is really done there. The second issue, and especially in cross-border cases, will be the relationship between resolution and insurance guarantee schemes that are fairly diverse. And the basic rule is quite clear that insurance guarantee schemes shouldn't pay more than what happens in normal bankruptcy. But how to really make this a reality in a cross-border case is difficult. But anyway, we have now the proposal for resolution of insurers. I think many of the issues in doing the resolution and finding out how it is fairly done are very close to the issues the actuaries deal on a daily basis. Thank you.
Thank you, Esko. Now, yes, thank you for covering the topic with also some of the very core principles and also the international aspect of this large topic. Thank you also for kind of going into more deep waters about the thinking around this, which certainly there is a lot to dive more kind of further, and you certainly gave a good flavor of the different topics that needs to be thought and discussed. Now we would step into the Q&A. Please, if you have still questions, do send them via the chat option to me or to everybody. I will try to keep my eyes on the chat here, but I think we certainly could start the Q&A now. I hope everybody speakers are here still. I would maybe, the first one would go to Malcolm, to you. I think you talked about the micro versus macro prudential tools and the risks there. I think maybe the question is that why all risks why there is risks that cannot be dealt with it with the normal micro prudential framework. You talked about, you gave the example of the low interest rate environment. I believe that one could also ask that when we have a kind of capital requirement for equity risk, there is a lot of kind of data behind that, but are we also talking about new risks and risk where we don't have that good sense? So maybe kind of the distinguishing between micro and macro, and why would we need macro to cover some of the risks? This might be repeating from your side, but did you get this, Malcolm?
Yeah, thank you for the great question. Maybe if I just use an example, Bran mentioned a desire to take our powers that in exceptional circumstances, supervisors, regulators could block policyholder redemptions. So what kind of circumstances might create that? Typically, if something's just affecting one firm, that's then pushing that type of firm into a resolution, and it would then be dealt with according to some kind of resolution process, as Esko's highlighted. But the thing about liquidity risk is that it's a very fat-tailed risk. If we use actuarial jargon, it tends to be very extreme, but only very rare. So if there is a really major event, maybe computer systems across the the financial sector all fall over at the same time. Maybe there's some kind of massive terrorist incident, whatever it is that triggers something that's affecting the system as a whole, then one can see that maybe you need to take action of the system as a whole and impose blanket restrictions to address the system as a whole problem. You can't do that, or maybe you have the legal powers to do it institution by institution, but in a sense, you're reacting by doing it across the whole suite of institutions. So it's to deal precisely with those kinds of broader risks that you need tools that can be applied across broad swathes of the industry simultaneously. Does that help to answer the question?
Yeah, it did, Malcolm. Thank you. Thank you for that. Okay, going forward, maybe Juan, there's a couple of questions. First might be on the liquidity risk you talked about. We know that this year we had the European stress test on insurance, where liquidity was one of the topics. I know that you haven't released any information, and not yet, but anyway, are you expecting to get kind of experience from this stress test to kind of maybe strengthen some of the thoughts that you already have, and as we know that the legal text is kind of it's still on the table. And the other question is about supervisory convergence. When we have the new kind of ideas on macroprudential framework, I know we are not there yet, but there's the implementation process, and there's lots of work for national supervisors. How would you see EIOPA's role and the workload here, Juan?
Oh, thank you very much for the questions. I think liquidity is, I think Malcolm also mentioned, it's a very interesting area. I think indeed we added some liquidity component also in our stress test. I think it's vital to understand a bit better how if liquidity could become an issue. Of course, we don't have results yet. We're working on it together with the colleagues more involved in the stress test. But there is something, that in our view liquidity has created, which is a kind of a change in our approach to liquidity. I have to say, when I focus on the macroprudential part, which is the part that I work at more, you could see also in Malcolm's presentation we had there, we explored the possibility of liquidity risks instruments some years ago. We decided, well, probably it's not needed because the way insurance work and the fact that you're cashing the premiums first and then you have plenty of liquidity available. But there are instances and where we have seen, what we are seeing that there could be, a risk. For instance, this is something we've also learned from the COVID crisis. We have implemented a common approach to monitor the liquidity risk of insurance. But also, we've changed slightly because we were not in favor initially about, measures to mitigate liquidity risk. And although we have not seen system-wide liquidity issues yet, it is clear also that, the outbreak of the COVID crisis has stressed the need for supervisors and authorities to have proper risk monitoring and stress testing framework in place. And this of course, is particularly important in the case of liquidity. The second issue was about supervisory convergence. I think this is very well brought into the discussion because, all this, they are always the other side of the coin. So we can have nice policies, but first we need to make sure that, that there is certain convergence in the supervisory sphere. This is very important. For this, we need good information, but we also need coordination there. And this is also why in some of our proposals, we have also added proposals to enhance coordination also in the supervisory sphere, precisely to ensure the supervisory convergence. I think if you think about the contribution, at least in my team, to the Solvency II was macroprudential, was recommended resolution, and what we see is that it all goes together with supervisory convergence. If you don't enhance supervisory convergence, then the rest will not be so effective. So that's a bit the idea. I don't know if this answers the question or.
It did. Thank you, Juan. Really helpful. Third, maybe Esko, you talked about the trigger points on recovery and resolution, the viability and solvency levels. Maybe the question is that should the actions be different if securing the policyholders or the taxpayers? Is there any kind of problem with the actions to be taken in the process when it comes to who to secure?
Well, I think this is a very interesting philosophical question. I think in insurance, if you look at the insurance business as such, there are really, of course, AIG is a different problem, but it was not really about insurance. But when you look at insurance and the problems of insurers, to my understanding, there are not so many examples of using taxpayer money to bail out insurers, but it usually is about like running down the business and cutting down the benefits, and even that has been fairly rare. But I think Juan was somehow reacting to what I said, but interested to hear what he says. But basically it's a bit unclear, and for example in bankruptcy proceedings we don't have usually the possibility of using taxpayer money to bail out insurers, and also I would say that the whole idea of having taxpayers cover insurance claims, it's kind of a new issue in this area. But Juan, you have experiences on this, don't you?
Yeah, well, we published recently a report on the insurance failures and near misses. It's the second report that we published based on information that we have available that we collect already for 6 years, covering over 200 cases or close to 200 cases of insurance failures. We collect cases every year, and what we see is that there are indeed failures in insurance. So insurance is, and of course, we also have had during the crisis situations where public money had to be used to rescue some of the insurance. Some of them also important ones. The Commission keeps track of all this public money that has been provided. So it is less often than in banks, that's for sure. But there are still instances where public money has been used or ended up being used in the course of the resolution process. So this is why we say that the overall objective of the resolution framework is actually to avoid that the taxpayers have to pay for it, because in the end, we have a clear hierarchy of claims where you start with shareholders, then you move on to bondholders, you move on then to policyholders. Although we know that, for instance, the Commission proposal, there is certain scenarios only where policyholders should be affected, and then in the end it's taxpayers' money. But you should assume, and you should start all your planning by assuming that there will be no public money involved, which is a situation in most of the cases, but we have had also instances where public money has been used.
Maybe it is so that in countries where there are forests, you don't use public money to save insurers.
Again, sorry, I didn't get it. Sorry, I didn't get the.
It was about your quote on you should see the forest for the trees. So I was saying that maybe in countries that have forests, like I know better the Nordic areas, in countries with forests, you don't use taxpayer money to save insurance.
Yeah. But as I said, this is the whole point of the resolution framework, precisely, trying to avoid.
Yeah, thank you. Thank you, Esko, and thank you, Juan, and also thank you, Juan, for mentioning the AFR's publication on the kind of near misses and the kind of the actions taking on recovery. I think that was really informative. Published a couple of weeks ago. I think it was so. Everybody, gentlemen, I think we are done with the Q&A. I see no other questions. We are also running out of time. I would thank all the presentators and presentations, which were highly really good. A lot of information. I hope everybody participating on the webinar now have a kind of better flavor on the macro-prudential topics and are able to take that part of your work, which is certainly something that we will need to understand this and also take macro side to when thinking in, say, ORSA and other topics. By this, I will end the webinar. Thank you, everybody, and please join the AAE webinars also in future. And you will get a questionnaire of this one. Please do answer. You will also get the recording of the webinar, which is which you can use. So thank you, everybody. Thank you, Malcolm, Esko, and Juan.
Thank you very much.
Thank you. Thank you very much.
Thank you.